Hello, I'm Van Hansen, and welcome to Macro and Mortgage for July. I'm here with Joe DiGiambattista, Principal Broker for Go Mortgage Co. Welcome, Joe.
Thank you, Van.
Before we get into the numbers, do you have a one-line summary of where the Canadian rate and lending picture stands heading into the back half of 2026?
Yeah, so it looks to be stable. I would say that would be my one word to describe it. And what I mean by that is we're not seeing any upward pressure on the BOC. And we were starting seeing a little easing on the bond yields. And they're kind of fluctuating just slightly up and down. So it's not really changing the opportunity much for consumers. So I'm seeing that, depending on what happens with the energy issues, we could see a more stabilized back half of the year from a rate perspective.
Okay, great. And so why don't we start with the calendar between the Bank of Canada and the Fed? What are the key dates our viewers should have circled this month, and what's the market expecting for each of those?
Yeah, so we're going to get our CPI announcement tomorrow. I think the projection on CPI is going to be, again, headline will be up a little bit, core will be flat. We'll talk about that in a second. And then balance of the impact to the BOC over August and let's say September, because the next reading is going to be in September. They take August off, is going to depend on what the energy prices do. And we were seeing a bit of a softening of impact on the energy prices with the ceasefire. That's now stopped. We haven't seen those rate increases find their way into prices yet. So that's still creating some downward or stable pressure on the CPI. So I'm thinking that we could be flat going into the rest of the year. We'll talk about that a little bit more. The BOC announcement on July 15th was flat, and it was been flat since October. So 6 periods have passed where they have not changed rates. We're getting that sense for the rest of the year as well, which is good for borrowers, and we'll explain that in a bit. U.S. is a little different. U.S. is having some uptick in inflation, which could cause some upward pressure on interest rates. So my personal opinion is I don't think we're going to see any change to the Fed over the summer, but we could see some Fed movement in the fall, which means we have to keep an eye on that, because if the Fed moves up and we don't, that's going to be inflationary on its own, and it could have an impact on the Canadian dollar.
So let's talk about inflation. Headline CPI ticked up to 3.2%, but you're telling me here that that's not the whole story. Can you walk us through why gas is doing the heavy lifting here, and how the bank balances the headline number against core inflation when they're deciding on policy?
Yeah, so the big number has always been headline because it gives you a snapshot of everything. But when you have an outlier that's causing disruption, you got to take a little closer look at core. So when we take out the heavy cost of energy, our core is pretty much bang on with what the Bank of Canada target is. So if you look at the chart on the right, you can see where that gap between headline and core is, and again, the core is below 2, and the headlines much higher. So the objective here is to see what the continued impact is on energy to prices overall. So we're seeing a spike in energy price, which is impacting headline but not impacting core. So there's no upward pressure on rates. But if that spike in energy costs finds its way into consumer products, gas, like truck deliveries and grocery stores and fuel surcharges by airplanes or airlines, then you're going to see that core inflation start to rise as well. So managing what's going on in the Iran war is going to be critical to see what that future impact is on rates. But as you can see here, just the headlines elevated only because of gas, and we don't expect any rate change soon. If the war continues and energy prices continue and they find their way into product pricing, then we could see core go up with headline, and then you could have some upward pressure on inflation.
Okay, thank you. And on the job side, we saw 18,000 positions created in June. Is that enough to call this a strengthening labor market, or are we still looking at some softness underneath the surface?
Yeah, I think we could call it a labor market that's not crashing. It's going from 6.6 to 6.5 is not a big deal. Going from 6.9 to 6.5 is a bigger deal. So the improvement from April to June, I think, is material. It means we had an amazing, I think, May, was it, with the jobs report, something like 88,000 net new jobs. 142,000 gross jobs. The US did like 175,000, and they have 10 times their population. So I'm happy that that the employment numbers are holding. Again, they're still high. I think we'd like to see that 6.5 down to like 4.5, kind of where the states are. But at 6.5 from 6.9 all the way back in April, after that bump from March, I think is positive news. On the employment rate side, we're seeing employment, gradually go up. That number's a little bit changed comparative to the unemployment rate, because the employment rate takes out people that have stopped looking. So it's gradually increasing because the numbers have come down a little bit. I think the better read is on the unemployment rate, where we can actually see unemployment dropping.
Okay, thank you. And so with inflation running hot on gas and core staying the same, what are the markets actually pricing in for the bank's next move, if any?
Yeah, so let's take a look at what the forecasts are on rates. I have a couple slides here on this. So you can see that the likelihood of a rate hike was pretty much non-existent for July 15th. It even goes down lower in September, and then again even lower in October. So we're not looking at any rate increases on the variable side, which means we have a pretty very competitive variable product. When we get into December, the blue column looks big, but it's still just a 28-29% chance or 27% chance of a rate increase. So that takes us from July 15th to December 9th. That should give some prospective buyers some comfort level that they're not going to see the variable rate pop. And that's important, because the variable rate's lower than the fixed rate. And we'll get into that when we hit the rate slide. But with the variable rate lower than the fixed rate, more clients are qualifying at the variable to get more mortgage. So knowing that mortgage rate won't go up, I think, is a little bit more comforting than being in an upward pressure market. So that's positive. Looking at the chart on the right, you can see that from October 25th all the way to the expectation is January 27, we're not going to see any rate movement. And if we do see rate movement in 27 in January and in April, it's only a quarter point. And it would suggest that our economy is performing better as a result, and they want to slow it down a little bit or just keep it in check. So again, our variable rates are decent. To go up 25 basis points, it's not going to impact the housing.
So Joe, with the variable rates not moving, how does that translate for someone making a rate decision, variable versus fixed?
Yeah, so it's a little complicated, but let me go through some historical data first. When you look at this chart here, you can see that from 2015 to 2021, fixed rates were higher than variable rates normally. Then we had the COVID, and during the entire COVID period, variable rate was much lower than the fixed, which was positive, but that caused inflation. So in 2020, just at the end of 2022, beginning of 2023, variable rates went up and started being much higher than fixed rates, and that lasted all the way going into 2025 as they increased the Bank of Canada rate to fight inflation. So the normalcy in this chart is the blue being over the orange. The fixed rates are traditionally higher than variable. There's no incentive to take a variable if the variable is higher than the fixed, because the variable is going to move. So most people gravitate to the fixed. But now if you look at the far end of the chart, right at the end here in 2026, you can see that spread's starting to happen. It's starting to grow, where the fixed rate is higher than the variable rate. So what that means for consumers, two things. One, they can get a lower monthly payment, so get more cash flow. And two, they can qualify for more mortgage amount because it's a lower rate if you get qualified on the variable versus the fixed. Now, the beauty of the fixed product The beauty of the variable products is you can convert to a fixed anytime with no penalty. So there's an incentive to take the variable. The variable also is fully open on a 3-month penalty, whereas the fixed is an interest differential and a much higher, probably about 3 times higher penalty to get out of the fixed. People usually gravitate to the variable when the market rate is lower than the fixed rate. The challenge here is that spread, before the war, it was starting to get to about 50, 60, 70 basis points was the difference between the variable rate and the fixed rate. Now that number shrinked. So even though the variable rate's lower than the fixed and you can qualify for more, there's not a lot of incentive with the future look at the marketplace, meaning what could happen in Iran if things get worse, what could happen with the US if tariffs get worse. There could be some negative impacting to pricing. So that spread's not big enough, in my opinion, for people to really automatically say variable is better for me. If you're comfortable with the mortgage payment and the spread is as thin as it is, I would still recommend fixed to clients today. If that spread between variable and fixed continues to widen, then I would go back and say, okay, now take the variable. You got a better margin, you got more room to play with, and anytime you can flip to a fixed if rates get out of control. So we were there for a bit where we were counseling just the variable. Now that it's come back a little bit, it's depending on the individual's personal situation. It's always nicer to have a sub-4 interest rate, and you can get into the sub-4 on the variable. The only sub-4 interest rate on the fixed is the 3-year, and we'll talk about that in a second. But so this is the kind of conversation we have with individual clients based on their own metrics, and then they can make that decision on their own. We don't give advice. We just show them what could happen in either scenario and what they need to do today to help them make a better decision for the next longer term.
Right. Thank you. So next up is the rate review. So what are the best rates actually available on the market right now? Insured versus conventional, fixed versus variable.
Yeah, so again, we got a really nice 3-year fix down to 399. The 5-year is anywhere up between 409 and 414. The 5-year variable is as low as 355. And again, we're not in a market where the entire lender spectrum is at these rates. These are the lowest rates offered by a multitude of lenders. So we're still in a choppy rate market because not everybody's here. These are particular lenders that are offering lower price points for certain products. So, for example, the 399 might be Scotia, but nobody else. The 355 might be BMO, nobody else. But we do have some low price points. It's nice to see the prime minus 90 again. We were seeing prime minus 65, prime minus 75 when the market was tough. To get the prime minus 90 is better for the consumer because whatever the rate moves to, they always get their 90 off. But then again, if you're 355 on a variable and you're 399 on a 3-year fixed, depending on your risk tolerance for interest rates, you might want to take the 399. It's a tougher decision at 414 for the 5-year. So we're not seeing a lot of the 5-year go fixed because people generally will gravitate to a 5-year when it's below 4. The only one below 4 is the 3-year. But again, those are great rates. To be able to do fixed rates and variable rates under 4%, 355 and 399 is good for consumers. Conventional side's a little bit higher, but the variable is still, is 375, prime minus 70 on the conventional side. And the 3 years, 50 basis points higher. And the 5 years, maybe about 70 basis point higher. So I think more people are gravitating to the variable on the conventional side. And they're gravitating toward the 3-year fixed on the insured side. And again, the conventional side, you're getting that more seasoned borrower. And on the insured side, you're getting that first-time home buyer, so it makes sense. One thing I do want to add, though, is that non-income qualified 1 year, that's down. So that means if you look at the non-income qualified 1 year at 459, and you compare that to the 5-year conventional bank offer at 444, that's only 15 basis points, right? That's only a 15 basis points difference On 500 grand, what is that? $750, right? That when you take the 459 versus the 444, you can qualify with your gross revenue, not your net CRA revenue. So if you want a $500,000 mortgage, you need 100 grand in income. To get 444, you got to declare 100 the CRA. You're going to pay 35,000 in taxes. Whereas on the 459, you can declare 20 grand the CRA, 100 grand gross, and now you're paying, on taxes, you're paying maybe 10 grand. So you're saving $25,000 in taxes, and it's only costing you 700 a year in interest. So sometimes best rate's not always the right solution. It's how you manage your rate and your income tax.
Thank you. Now, Toronto households are still needing over 65% of income to cover ownership costs. Is that trend improving, holding steady? Or are we
Yeah,
seeing...
so the next three slides really, we want to tell a story. So when you look at affordability, yeah, so affordability in Toronto is still high at 65.2. Vancouver is worse at 84.1. Canada's at about 53. But when you look at the chart on the right, you can see that we've recovered half of the affordability impact from 2022, 2023. So we're 50% almost more affordable than we were 2.5 years ago, right? That's a result of price drops, and that's a result of interest rate drops, right? And if we see stability in the interest rate market and we see houses flatten, that affordability is real. It's real from 2 years ago. I have first-time home buyers that I've been working with for 2 years that I haven't bought. And now they're looking at houses for 700 that 2 years ago they were looking at 850. And they're trying to make that work. Now some of them are getting greedy and trying to even go higher, because if they can buy for 800, that house last 2 years ago could have been $1 million. So there's the affordability feature is having a huge improvement for first-time home buyers. My concern, can I jump into the next slide?
Sure.
My concern is that when you see this stuff, right? So this is the Toronto housing market. This is the change in June. This is showing us that we're almost up 10% in home resale from a dead market, and we're almost down 12 to 15% in listings. What happens, Van, when listings go down and resale activity goes up?
Well, the market starts heading the other way from buyers to balanced.
Right. So I don't think we're going to see price increases yet. But what we are going to see is we're going to see an erosion of inventory, which is going to lead potentially to multiple offers on properties, which is going to lead potentially to sale prices over list. And then going into the spring market of next year, depending on what's going on with the US and what's going on with Iran, if we have a tailwind, not a headwind, if we have a tailwind, then you could see some potential upswing in certain markets. I think the condo markets is going to be flat for a couple of years. That'll depend on whether they open up the foreign buyer ban in January 2027, which I'm hearing rumors they might. So that could be positive. But my concern here for first-time home buyers is you have time, but it's not indefinite. If these numbers persist, where we're selling more houses than we're listing, it's going to tighten inventory, and that's going to have an impact on first-time home buyers.
Right. And Joe, this one kind of pops out. Toronto, we talked about last time, and whether it was a blip or trend, is it kind of trending now, or we still have to wait and see?
Yeah, I would say it's a very soft trend. So we've been busier May, June, July than we were December, January, February, March, even April. Right. So May was good. April started getting better. May was good. June was good. July still looking good. So people are still actively trading in real estate. I would suspect we're going to get a little bit of a lull for August. We always do. And I think the tail of the tape is going to be September. So if we start to see a rebound, a resurgence in September, it doesn't even have to be more than what we're seeing today. Then that would lead me to believe that we're tracking in the right way. Because what's happened is, if we haven't resolved the war in Iran and we haven't resolved tariffs, but we're starting to track up, it means people are ready to make some moves. And then what's going to further be a catalyst to that is if we do fix the Iran war and we do fix the tariffs, then if people are already doing this now with all this uncertainty in the marketplace, what's going to happen to the market when the uncertainty goes away? If the uncertainty goes away, it's going to start to jack, right? So I think that if you're on the cusp of affordability, you should probably be doing something in the next 6 months. If you're looking for value, best price for your for a buy, you should probably be doing something in the next 6 months.
Okay, thank you. And Joe, before we wrap up, anything on your radar for the next 30 days that our viewers should be watching for?
Yeah, I would say let's keep an eye on the Iran energy issues. What happens to the price of oil and the length of that timing to the price of oil will have an impact on inflation. If we start to see that price of oil start to impact consumer goods, we could see some potential small bump in variable. But we have room. If that 355 goes to 375, it doesn't fill the market, right? And then you've got the flip side with tariffs. It seems like we're status quo, which means that yes, with all the negativity and the noise and some maybe lackluster investment in Canada because of the uncertainty, we're still 90% covered under our goods and services. That hasn't changed, right? And for the U.S. to cease CUSMA, it would take an act of Congress. There's some comfort that CUSMA will manage itself through, but right now it's still not overly negatively impacting the economy. We're still above the line. We're not in a recession, but it's largely in part because of the 90% exemption under the CUSMA rules. So I think we've got to stay vigilant and keeping an eye on the impact of energy prices making their way into the consumer system. And I think we have to keep an eye on just what's going on south of the border.
I'm Van Hansen for Macro and Mortgage here with Joe DiGiambattista. Thank you, Joe. That's great. I will see you next time.
Thank you.